guys. Thanks so much. Paying down your mortgage or saving for retirement, which is the best place to put your money when the purse strings are getting tighter? We're going to talk about that next on the opening bell. Don't go away. More of Connell. Well, food prices are going up, gas prices are going up, home prices are going down, and people's budgets are getting tighter. So how do you know where to put your extra cash towards paying down your mortgage or building your retirement nest egg? Brad Levin is with Legacy Wealth Advisors, and Craig Karnick is with Karnick and Company. Good morning, gentlemen.
Good morning.
Good morning, Alexis.
All right, so Brad, we're going to get started with you. You are for keeping your mortgage in retirement. Give me the reasons why.
Well, first of all, you've got a big need that you've got to cover against in terms of protecting yourself for inflation over your lifetime. As you were just discussing, the issues with rising energy costs and food costs. Of course, healthcare is a major concern for retirees as well. In fact, a recent report from Fidelity Investments is projecting that a couple at age 65 needs to be able to cover between $225,000 or more between age 65 and 80 in medical care costs out of their own pocket. So you've got to have reserves available to pay those expenses as they rise. Your mortgage is likely to be the one expense that you'll have during your retirement lifetime that's not going to go up. So why take your very important resources and pay off that one expense? The other issue you have to consider as well is the after-tax cost of your mortgage. Because you can deduct your mortgage interest expense, you're likely to be paying a lot less net out of your pocket than you could likely earn from your investment portfolio. So, for example, if your mortgage is costing you 6.5%, that's pre-tax. After tax, you're likely to be paying under 5%. And over time, you can have your money invested in your portfolio and do quite a bit better than you can with the cost of that mortgage.
All right, Craig, you are not for this, and you say pay it down before you retire. Give me your reasons why.
Absolutely. It's an emotional security thing. When people retire, given all the fluctuations that can go on out there, the stock market, perhaps even companies abrogating their retirement plans, you want to have your home paid off. Home sweet home means a lot to a retiree. And the only people who really advocate keeping the mortgage are people who want to take that money and have you invest it someplace. The best investment a retiree can make is to time it so the day they retire, the mortgage is paid off. Emotional security is what retirement's about, not getting the best return.
Yeah, Brad, I mean, I think Craig makes a valid point there. It's also one less thing to worry about. And as you mentioned, healthcare costs rise. Wouldn't you want, you know, some of your money sitting around in cash if, in fact, you could maybe downsize your home? You know, look, people make those decisions heading into retirement, don't they?
Absolutely, and we tell our clients that the emotional security is definitely a factor to consider. But the bottom line is your financial security will have an impact on your emotional security as well. And people complain about not having enough resources available to cover these expenses. When you take that cash and invest it in your home, it's tying up more money that's just not available to use for other expenses. So aside from the emotional aspects, the financial issues really bear out in the end.
All right, Craig, jump in
greater
there.
Liquidity.
No, I just don't buy that. The emotional security is key. You want to get the mortgage paid off. Your expenses go down. You don't have a mortgage payment. If something goes wrong, that's one more payment you don't have. Plus, there's transitions here, Alexis. People who retire are on their way to completing their life trip. They want to be thinking about 10, 20 years down the road. Maybe a reverse mortgage is an idea in later life. You don't want any mortgage strangling you like an albatross. Get rid of that mortgage when you retire, and don't listen to anybody who says take the money and invest it. From a financial planning standpoint, that's absolutely the wrong thing to do.
You know, Brad, it is a very important point, though, because some people say, oh, you can annuitize or create an annuity by borrowing your home, and that stuff is bad, right?
No annuities.
Well,
please.
if you're going to look at the idea, of doing a reverse mortgage, why go and borrow money out of your home equity later on in life when instead you can keep that money available and get the benefit of the tax deduction now while you do have those costs? Keep that extra cash available, even if it's sitting in a bank account. Even if it's sitting in a bank account, you have that liquidity, which is really important in terms of being able to cover the rising cost of medical care. And as we're seeing right now, energy expenses. We deal with clients who are primarily retired or transitioning into retirement, and they're very concerned about the rising costs that they're facing right now.
You're stretching it. You're stretching it. Why would you put money in the bank? That's not sensible. Cut it out. Simplify your life. Focus on your retirement existence. That's the thing to do. Get rid of that mortgage and be working with a fee-only financial planner to make this 10, 15, 20-year transition. There's so many things going on when people retire. Getting a mortgage and keeping it during your retirement years is a bad idea. Pay it off. That's one less thing to worry about, and that goes to peace of mind. And in retirement, Alexis, the only thing that counts is peace of mind. And you know, if the market reverses, if the company declares bankruptcies like some of the airlines are about to do, if they abrogate their retirement plans, who knows what's going to happen with Social Security? No. Get that house paid off. Then when you downsize, you can sell that house for cash in later years. You don't have to worry about a mortgage. You don't have to worry about property evaluations. You don't have to worry about interest rates.
All right.
It's senseless.
All right, Brad and Craig, it was great having you on. I think the kids would
Thank you.
agree. The kids of the parents there would probably go in Craig's category there. But all right, guys, we'll leave it there. And I look forward to having you back on again to debate it in the future. Thanks so much.
Thank you.
We'll
Have a
be
good
right
day.
back with the opening bell.